Afternoon, everyone, and thank you for joining us today. My name is Greg Burris, and I'm the Director of Investment Portfolio Oversight and Reporting. And on behalf of the executive leadership team at Foundation for the Carolinas, we certainly thank you for attending this call. If at any time during the webinar you have questions or would like further clarification on a specific topic, we invite you to post your questions in the chat window. Tim and Travis, the Mercer team here, will address these after the presentation during the Q&A portion of the webinar. And if we do not get to your question, we will follow up with you after the webinar. This is being recorded, and the link will be available on the website, My FFTC portal, shortly after the presentation. I will now introduce Travis Pruitt and Tim Westrich, who lead our consulting relationship at Mercer. Travis will be leading the discussion and will address market conditions and certainly performance in the first quarter of 2022. Travis, I'll turn it over to you.
Great. Thanks, Greg. And welcome, everyone. I hope all are well this spring afternoon. So we will run through markets. We'll give you a sense of performance. We'll make sure we have some time for questions and certainly hope to give you a good sense of how we see the portfolios relative to the current market environment, give you updates on where we think we're going. So it was a pretty interesting first quarter. To say the least. We saw a lot of volatility right out of the gate in January, and that resulted in negative returns for most asset classes. And in a rather unique turn of events, in a pretty meaningful down market for the first quarter with global stocks down about 5.5%, U.S. investment grade bonds were actually down more. We did see interest rates move dramatically over the 3-month period, and in fact have gone higher still since, where the 10-year Treasury ended 2021 around 1.5% and ended the first quarter about 2.4%, and today is inching ever so closely to 3%. So that did cause a drawdown in bonds, and that set a pretty challenging environment for all asset classes in the first quarter. So as investors digested this notion of Fed tightening and the Fed raising interest rates to attempt to tackle inflation, coupled with some pretty significant geopolitical risk, we did see almost everything off for the quarterly period. Most of that was started really with a change in interest rates. So as I mentioned, the broad U.S. investment grade universe as measured by the aggregate bond index, down almost 6% for the quarter. And you can see as you eye down that section of the chart that longer treasuries and longer credits, things with longer maturity, sold off even more. So it's pretty dramatic, but very few places to hide within bonds. Even within TIPS, albeit better, Treasury inflation protected securities, even TIPS were down for the quarter, albeit marginally better at down 3%. That impacted equity returns at the top half of the page. U.S. large cap stocks as measured by the S&P did hold up pretty well, but we did see continued shifting in style leadership. So for a considerable number of years, we saw the growth half of the marketplace really lead results. And in this first quarter, we saw a pretty remarkable divergence between growth and value. And I just capture those here, circling the Russell 1000 value, which are large cap value stocks. Immediately above that is the Russell 1000 growth. So you can see the spread between large growth and value stocks for the quarter, and similarly small and mid-sized stocks for the quarter as well. It was a substantial movement. Much of that movement in style was attributed to differences in returns amongst energy. And so on our chart here, we're capturing energy leadership primarily in the form of the Bloomberg Commodity Index, but you can see for the quarter up nearly just over actually 25%, reflecting both strong demand, geopolitical events, as well as other supply challenges in the energy patch. And so we did see stocks, excuse me, and the related commodities along with those stocks really perform well in the first quarter. Again, one of the very few places investors could hide in the first stanza of the year. When we look over the trailing year, we can see that it still reflects over that 4-quarter period very strong returns amongst large cap stocks in the U.S., where the S&P 500 was up better than 15% year over year. So we did see consolidation in the back half of last year into large cap stocks, and you can see that to a certain extent in the relative underperformance of the Russell 2500, which is our small and mid cap index. Additionally, similar to the first quarter, over the course of that 12-month period, markets that are more sensitive to inflation also performed well. So in addition to commodities, which were up nearly 50% over that 12-month period, things like REITs, which are real estate investment trusts, as well as global infrastructure, which is this global core infra benchmark right there, also generated really pretty meaningful positive returns. Similar to the quarter, fixed income returns and other markets like small cap growth and emerging markets struggled pretty mightily over that 12-month period, as investors have begun to evolve their thinking on risk and adjust some of those stimulus that I spoke about presently. Excuse me. Digging just a little bit deeper on the style performance, I touched on this. Regardless of asset class size in the quarterly period, it paid to be value. Most of that value contribution did come from differences in energy stocks. Regardless of size, were pretty much leaders across most of their categories, whereas more speculative names that are typically found in growth indices and even more so in the smaller cap indices really struggled as investors digested the potential for higher interest rates, as well as potential for changes in economic outcomes. Low volatility, which is a meaningful allocation within both the U.S. equity and non-U.S. equity building blocks, it reinforced why we like it for those portfolios in periods like this when equity market momentum breaks down and momentum in the markets is negative. The minimum volatility, the lower volatility strategies of Martindale and Acadian both held up really pretty well in the quarter, as demonstrated by this particular benchmark. So that's a brief recap. Some of the things that we think are important to think about or consider in relation to market events so far this year. The markets were off to a rough start at the beginning of the year. We did, as you can see, this is a cumulative return chart for the period up to the end of March. And you can see in the front left-hand side of that chart that most asset classes were down for the first month and a half of the year, led by the NASDAQ, which is, again, reminiscent or indicative of some of those more speculative stocks that have sold off an awful lot here more recently. The pink line at the top is emerging markets, and you can see that after what had been a somewhat challenging 2021, emerging markets were ahead of the pack for the first month and a half of the quarter. But the recognition by Russia of the two eastern Ukrainian provinces as sovereigns, and then shortly thereafter with the invasion of Ukraine, with the exception of emerging markets, which you can see that pink line, if you will, caught up with the other major indexes. By and large, the advent of war has not necessarily resulted in a lot of additional downside, at least heretofore. More important to the conversation on volatility has really been about inflation. And you've seen this chart from us a few times before, but this is rolling 12-month inflation, and the blue line is broad CPI, and the green line is core CPI, which is basically CPI less food and energy. And you can see that for the last several months, the year-over-year prints for inflation have been pretty significant. I think to some extent even surprising to the high side on the last print. We are seeing sometimes some signs of moderation in inflation, but this has definitely been the story of the last several months, and in the story really of the most immediate horizon. I mentioned a couple of times that energy were a key driver of value performance, and that's been driven in large part by near-term high energy prices. So the chart on the left is the forward oil's futures curve, And so what this curve tells us is market expectations for prices over differing periods looking forward. So at the left-hand side of this chart, you can see the green line is right about $100. And this chart's a couple of weeks old, but the tenor still applies. You can see that there's a higher cost of oil implied in nearer term futures than if you go out months. So the scale on the bottom of the chart reads, for example, 2 months, 6 months, 10 months, 14 months, et cetera. Those are 14 months forward. And you can see that expectations for the price of oil are coming down on a forward-looking basis. So as a contributor to inflation, should the futures market be correct, we might expect to see moderation in those components, and those very meaningful components of the overall inflation expectation. On the other side of that coin, though, we have seen wage growth continue to grow on the bottom right-hand chart on this page. Each of these lines are a slightly different way to measure wages across the economy, but you can see that they are all, by and large, still tilted up. And wages historically have contributed to a little bit more durable inflation readings over time. Much of these wage gains have been at the lower end of the spectrum, which, all things being equal, is a relative positive as folks tend to spend the marginal dollar more actively in that part of the economy, and so that's generally pretty good for expectations for growth. But nonetheless, higher wages may be an ongoing contributor to higher inflation. So generally speaking, we think the economy, we have thought the economy is in pretty good shape, although we might expect to see it slow as we go through the end of the year. We do think interest rates, still the general trend is higher. Markets have priced in quite a bit of activity by the Federal Reserve, but the Federal Reserve itself has actually been not that active yet. They've only raised short-term rates by 25 basis points in their first move. There are expectations for rate moves in May of closer to 50 basis points and perhaps higher in following months. But the market's priced in and done an awful lot of the Fed's job heretofore. So we think there could be some volatility around this and some interesting dynamics as we move through the year, as the Fed almost catches up to market expectations, or market expectations come realign to a Fed reading near-term data. Why don't we transition from performance of the markets and talk about the funds and how things went. So you can see just on a broad scope, the story for our equity options or equity-oriented options and real assets for the quarter aligned pretty well with the outcomes we discussed in the broader markets. Generally speaking, equity markets were negative. And that's really in the top half of the group, and real assets, by and large, were positive in the quarter, with the exception of REITs. And then over the course of the full year, again, more strength in U.S. equity securities, where we have a bias towards larger cap, and of course, at the bottom of the page, pretty healthy long-term absolute returns, or one-year absolute returns, for our more real asset sensitive or inflation sensitive assets. So from an active perspective for the quarter, both U.S. equity and non-U.S. equity both outperformed over the course of the quarter. We're very happy to see that. Pretty broad-based participation in active management. So not just one or two names driving performance, but pretty good overall, and good, benefiting from our diversification. You will note the non-U.S. equity over the trailing year is a bit behind its benchmark. It had some underperformance late last year, but so far year to date, I believe we've pretty much closed that gap and overcome some of that short-term performance. So really pretty happy with those two building blocks currently. At the other end of the spectrum, more challenging performance came out of both emerging markets and global opportunities. On emerging markets, basically allocations to China and Russia were challenging. We were modestly overweight to Russia and about market weight in China, and those were challenging places to be. The Russia issues are very apparent. China has been struggling with outbreaks of COVID and their response and shutting down, basically closing cities, and that's put a real damper on economic performance, and it has It's caused investors to pull back some in the interim. So it will be very interesting to watch how China evolves and emerges from these recent round of COVID issues. But in the near term, we might expect to see more volatility, maybe some more downside pressure in some of those markets as a result. Global opportunities, which we talked about a bit here over the last several months, as it did struggle last year and didn't have a particularly great first quarter. Again, this is our very active strategy within the diversified long-term growth portfolio. A little bit more esoteric or idiosyncratic active strategies. We do have some additional exposure to China as well as some sectors in here. So it was a pretty rough quarter. Most of that underperformance the lion's share of the underperformance came in January as markets remarked risk. But as we've talked about before, we still very much like the strategy. It has been painful to own here in the near term, but we recognize it has excess volatility characteristics. We continue to evaluate the sizing, but the underlying managers, the underlying positioning is still very much like for the long term. And then I touched a little bit on the real assets. Again, we own between 5 and 10% in the long-term pools in real assets, and those have been definitely contributory to overall absolute results as well as relative results over the last year. We have and continue to keep those reasonably close to targets because each of these individual pieces can have a bit more volatility. We want to own them as a basket and get the collective characteristic, but we want to make sure we don't get whipsawed in any short-term reversals that we otherwise might not get paid to risk we might not get paid to take. Looking at the risk-reducing assets, as I mentioned, there were not many places to hide over the quarter, so virtually everything was negative, including bonds. Our hedge fund portfolio, which again is in the diversified long-term growth pool, outperformed modestly against its fund-to-fund index. From a longer-term strategic positioning perspective, this is what we would hope for from the strategy, which is when stocks are challenging and bonds are challenging, we get a decent result. And in fact, if we just compare that hedge fund line for the quarter and the 1 year versus the fixed income lines below it, we can see that on an absolute basis, really pretty happy that we own these positions and that we have this kind of diversification in that portfolio. For the fixed income managers themselves, we had a little bit of underperformance from the fixed income pool for the quarter. As you can see, about 40 basis points behind, primarily due, to spreads widening in credit. So as investors digested increasing risks, they did sell off corporate bonds a bit more than treasuries. Both of the managers within the fixed income portfolio tend to bias towards corporate securities, so perhaps not surprising to underperform in this quarter. Year over year, still some premium versus the benchmark, and similar to the non-US equity, much of that gap on a year-to-date basis has been closed as the managers have kept deployed, kept their feet in, and have diligently gotten us back closer to benchmark year to date. Similar story, although a little bit better on a relative basis in low duration. Sterling is the manager both in the low duration standard pool as well as we have allocations to sterling in some of the other pools. Being shorter duration has helped in those other pools, and sterling has done a really pretty nice job of outperforming in a tough environment. So the building blocks roll up into our standard pools on a quarterly basis from the standard pools, basically in line for our standard pools, most notably income and growth and active long-term growth, plus or minus 10 basis points versus benchmark. So nice participation in the market, didn't give up a lot of ground. As I noted, diversified long-term growth, a little bit behind its benchmark for the quarter and a little bit more so for the year, primarily on underperformance for global opportunities. So again, that's a position because of its impact here. We keep a close eye on it, but like I said, we still like it. In the short term, that has caused some underperformance though. And then the ESG donor pool, which is newer, also tends to not have much energy exposure, and since energy mattered a lot, that contributed to some underperformance for that strategy in the quarter as well. For that year-over-year period, perhaps not much to write home about in terms of absolute returns, but as we saw the distribution of returns across asset classes earlier in our discussion, we're participating pretty well over that trailing 12-month period. So passive long-term growth, if you will, setting the benchmark at 3.5, basically flat performance for income and growth, and then similar performance out of active long-term growth with a little bit better absolute number out of diversified long-term growth. So I think strategy-wise, we remain pretty happy with our overall approach. As always, we continue to vet the underlying managers and positions to make sure that we're comfortable where we are. We have been overweight at the margin in emerging markets. That's a position we're reviewing today. No pending manager changes in the near term, but as I said, we're constantly and diligently making sure we stay on top of the names that we own on your behalf, and that we continue to strive to deliver the best returns we can throughout the different markets. So, Greg, I'll stop there and field questions.
All right, thank you, Travis. We do have a couple that have come in, and we certainly encourage you to, submit your question in the chat window. First question is, what do you see the likelihood of a recession?
Well, I guess we'll have one again someday. Not to be too flippant. Timing really matters here. I think we discussed this in our internal team meetings just a day or so ago. Expectationally, we think probably 2023 is the most likely, perhaps as early as late in 2022, but we think early 2023 or into 2023 is more likely to see a recession. The Fed is trying to get a handle on inflation, and their tools are limited and somewhat blunt, but by raising interest rates and making the cost of money more expensive, that historically has tamped down economic activity in a way that reduces demand and therefore eventually reduces inflation. And it's a very difficult balancing act. You'll hear terms like attempting to engineer a soft landing. That sounds very cool and perhaps even easy in some minds. That's an incredibly difficult thing to pull off, to slow the economy just enough that we cool growth, we keep inflation, but we don't lead to, say, a major pullback in economic activity. So we do believe rates are going to go up and remain up while we try and get inflation. And by extension, when you couple that with the potential for recession in Europe, for both reasons of energy costs as well as just geopolitical risk, and the challenges we see in a market like China today, we think 2023 we could see a recession in that market.
Okay. Yeah, Travis, one of the things that is widely talked about in commentary in markets is the spread between the 2- and 10-year Treasury, and a lot of prognosticators use that as an indication of the likelihood of a recession in the future. And so that metric did invert in March, since returned to positive spread between the 2- and 10-year. And that was largely driven, like Travis said, by the aggressive indications of Fed tightening. So we see the front end of the curve come up. Another thing that we're watching, though, is a sharp re-steepening of that curve, because that indicates that there has been a policy error. The Fed's going to have to ease policy. So if we see a sharp re-steepening of that, that's also an indicator that we're looking for.
All right. Well, thanks to you both there. And I think, Tim, both of you hit on, the next question, I think has been answered, but I'll put it forward to see if you want to, say anything else. What do you think would cause the Fed to pause in raising rates?
I think spikes in let's call them significant negative changes in employment. Right now, the employment indicators are all very strong. There are apparently far more jobs than there are people who want them. And so that has been contributing to some of those wage numbers that we showed. If we saw that data change remarkably, that could be an item, or any of the other major indicators around economic growth. If we saw those fall off pretty significantly, we could see the Fed react. But I suspect it will take more than one reading of those kinds of data to cause the Fed to pause. You know, we had a negative GDP print in the first quarter, for example. I don't think that's caused even a blip in Fed activity, because it was, in that case, it was driven largely by trade. But I think if you saw more of the domestic indicators start to show meaningful weakness, you could see the Fed pause. But current communication appears that they are very focused on getting inflation under control and doing what they need to do that.
Okay, thank you. Another question. April was an even more difficult market environment. Can we get a preview as to how the funds did in April relative to the benchmarks, particularly the Global Opportunities Fund?
So broadly, most everything was down again, including bonds in April. We saw rates move higher. We did see in the last couple of days of April, the S&P 500, if you will, join the party. So the S&P had been pretty resilient, primarily because names at the top of the index had not experienced the same kind of downturn as others had. So names like Apple and Microsoft and the like had not yet experienced any downturn. We saw that happen late in April, which caused the S&P, again, it sort of to catch up. Year-to-date numbers, I don't have them open in front of me, but they're sort of low double digits for U.S. equity markets year-to-date through April. Similar for non-U.S., similar for emerging. I don't think, Tim, I don't know if you've got an estimate on, I haven't heard any estimates on Go yet.
I haven't seen anything. Usually, you know, we're a couple days early for that after month end. So it's usually B day 5, business day 5 or 6.
Yeah. Crossing fingers, but just thinking about the underlying characteristics of that strategy, probably I'm hoping for in line, which means still down for the month. A little bit more downside risk in that potentially, given some of the expectations in it. But so I would expect it's not going to be fantastic, but I'm hoping for in line for the month.
All right. Well, that was the last question we had. Again, Travis and Tim, thank you for your insight and being with us here today. And thanks to all of you participants. We do hope you found the webinar informational. And just a reminder, we are going to be posting a recording of this on my FFTC resources, and as soon as possible after the webinar. So hope you have a good rest of your week. Thank you.
Thanks all. Take care.